Hello and welcome. Today we will talk about the Non-Financial Reporting Directive and the implications that an update to the directive may bring to European companies. We will discuss who may be affected and how, what didn't work and why, and what needs to be improved for the directive to deliver on its intended purpose. Richard Howitt planned to join us for the discussion. However, yesterday evening he informed us that he won't be able to participate. He has later confirmed on Twitter that he's being treated for COVID-19 at his local hospital. We're wishing Richard all the best and hoping for a speedy recovery. To open the webinar and provide us with an overview of the directive, we are joined by CDSB's Managing Director, Mardi McBrien. Joanne Houston, EU Policy Officer at Frank Bold, will continue by sharing insights into the recent study on company sustainability disclosures released by Alliance for Corporate Transparency earlier this year. Joanne will be followed by Michael Zimonyi, Policy and External Affairs Director at CDSB, who will update us on key proposals to strengthen the directive. My name is Julia Kislitsina. I'm moderating this webinar today. I'd like to encourage you to submit your questions. You can use the Q&A option that you will find on the top right-hand side of the screen. In case you don't see it, you can use the chat option. To activate it, click on the chat icon in the menu bar at the bottom of the screen, and the chat will appear on your right-hand side. Feel free to ask your questions during the presentations, and we will address them towards the end of the webinar. This webinar will be recorded and distributed along with presentation slides.
Thank you, Julia, and thank you for having me along today at such short notice. It's big shoes to fill, standing in for Richard Howitt today as rapporteur of at least 3, but if not 4, CSR committees across Europe over the last 20 odd years. So he's left a huge legacy in the environmental and sustainability space in Brussels for us, not just with the directive, but many other endeavours across Europe as well. So we wish him, like Julia said, a speedy recovery, and hope he'll be back to his full energetic self again soon. So I hope I can do him justice with my own energy today. So I'll start briefly by just giving a quick introduction to CDSB, and then we'll move along to the directive. So CDSB was set up in 2007 at the World Economic Forum's annual meeting in Davos, and is made up of a group of 9 business and environmental NGOs that have an all interest in sort of the climate environmental space, aligned with corporate reporting and disclosure. We're chaired by the World Economic Forum, and we're based inside CDP Worldwide, or the Carbon Disclosure Project. And we're supported by a large group of insanely talented individuals that, again, share an interest in really trying to transform and drive forward the corporate reporting landscape. So our work, in short, really exists in the absence of an international accounting standard to put climate and latterly natural capital into annual reports with the same rigor as financial information. And we deliver on this mission through a framework which helps companies report climate and environmental information in a consistent, comparable, decision-useful way. It's just helping companies do what they should be doing already, which is reporting risk to capital markets. So the framework, it's a principles and requirements-based framework, which is very similar to corporate reporting guidance and standards that you may already be familiar with. We have 7 principles and 12 requirements. The guiding principles are the how, and the requirements of the what to report. The principles and requirements are fully aligned with the TCFD recommendations. The TCFD was developed based on the CDSB framework and other leading frameworks, such as SASB. And in saying that, the framework is also completely complementary with CDP, GRI, and existing regulations. So you can use data you have collected to do other reporting via the CDSB framework and into your mainstream report. The framework is referenced topically based on today's webinar in the EU non-financial reporting guidance, and is also referenced, for example, by other regulators and stock exchanges globally. The non-financial reporting directive, how did it come about? At the time, Richard Howard was the rapporteur, and they deliberately put in place light touch regulation. But actually, we should go further back than that. We should go right back, almost to the, well, not almost to the beginning, but further back and give a bit of context. So as far back as I remember it, which was in April 2011, as part of their EU Single Market Act communications, they identified the need to raise a similar level across all member states of transparency around social and environmental information by entities. And then that sort of evolved a few months on and was reiterated in the EU's 2011 to 2014 strategy for corporate social responsibility. From there, in February 2013, the European Parliament acknowledged the importance of business reporting on social and environmental factors with a view to identifying sustainability risks and increasing investor and consumer trust. And they really sort of acknowledged as part of their communications at this point, the key role disclosure of non-financial information could play in managing change towards a more sustainable global economy by combining the long-term profitability of companies with social justice and environmental protection. And as things progressed, this led to a proposal to amend the European Union's accountancy directive. So in December 2014, the European Parliament adopted the directive as we know it today. And by the end of, and as of the 1st of January 2017, companies year end that fell after that date were required to apply the directive to their reporting. So a bit about the directive. So it requires, as I said, sort of in thinking about the preamble to the directive, what it requires is the reporting of environmental, social, and human rights information that previously wasn't required in a company's annual report, in a non-financial statement, or in another report up to 6 months later if you're unable to do that. It had a scope of companies over 500 employees, so public listed entities. And what I mean by public listed entities, that's listed companies, banks, insurance companies, and other companies designated by local authorities in each member state, European member state, as being public interest entities. So that's roughly around 6,000 companies. And it required companies, and this is very similar to the Task Force on Climate-Related Financial Disclosures, for those of you sort of also familiar with that. It required companies to look at the business model, policies, policy outcomes, principal risks, and KPIs. But why is it important? The directive was developed to help investors, consumers, and policymakers and other stakeholders to evaluate the non-financial performance of large companies and encourage these companies to develop a responsible approach to business. And it was all about helping companies tell that story about how they create value and integrate value across their business and help them tell that story. And that's really important because there's an increased recognition, and many of you on the call will be very familiar with this today, that profit and loss and net assets are no longer reflected in the real value of a business. And although the statistics vary, and some go as low as saying that only 20% of a corporate value is actually on the balance sheet, and the rest is made up of things like human capital, brand value, contact lists, carbon efficiency, culture, and other intangibles which cannot be capitalized on using accounting standards. So a non-financial statement is a way of helping to communicate that, tell a company's value creation story, and then integrate that across the business in its reporting. So the heart of the directive, it was also key to provide consistent, comparable, and decision useful information to the investor, so the investor can help to mobilize, to make more informed allocation decisions and help mobilize capital to the more sustainable future that we are looking for at the moment. So, as is common with all the directives, they go into place, as we said, they went into place, started in 2017. They've had a period to be tried and tested by all the companies across Europe. The member states have had a chance to implement them into their own regulations, see how they played out, see what worked. And now it's sort of finished that cycle. It's acknowledged that the directive needs some work to achieve the ambition of the European Green Deal, the EU climate targets. So it's opened up for consultation again until May 14. And Michael will tell us a bit about that at the end of the webinar today. So although I'm not Richard Howard, I hope I've managed to deliver some of this with the energy and enthusiasm that he put behind getting the directive to where it is today and the significant changes that he has made. I'm going to hand it over to Joanne now to talk us through some of her research.
Thank you very much, Mardi. Excellent. So good afternoon, and I guess I should say also good morning, depending on where you're based and located at the moment. And thank you very much, Julia, for your introduction and also your presentation, Mardi. And of course, all the best to Richard for a speedy recovery. Today, I represent the Alliance for Corporate Transparency. I work at Frank Bolt, and I would like to present the research that the Alliance for Corporate Transparency has, let's say, conducted over the past year. So I think the first thing to do is probably to explain what the Alliance for Corporate Transparency is. And overall, let's say that it brings together a number of NGOs and reporting frameworks, such as, of course, CDSB. They all work on sustainability and corporate transparency, and it's all leading organizations in this sense. And the overall objective of the Alliance was really to provide evidence-based recommendations on the need to standardize corporate sustainability reporting, as reflected, of course, now in the confirmation that the European Directive on Non-Financial Reporting will indeed be reviewed by the end of 2020. Now, the Alliance for Corporate Transparency has assessed the sustainability disclosures of 1,000 companies across Europe. The results, as mentioned by Julia earlier on, were recently launched at the beginning of this year, actually in February, here in Brussels, and it really represents the broadest study of this type to date. And when we look at the slide and we see all these different organizations and leading organizations in the field of sustainability and reporting, the main contribution of all these organizations has been to combine their expertise within their specific areas of work and their knowledge to develop the methodology that was then used by the Alliance to assess the reporting practices of companies across Europe. And the result was, a very in-depth methodology with hundreds of criteria looking at different sustainability areas, providing data on how companies report across Europe. A very important aspect to highlight is that the methodology is based on existing reporting frameworks. So in no way the objective was to create something new or create new standards or new frameworks. We really extrapolated the data and the standards from existing frameworks. And everything was, of course, also built in line with the requirements of the Non-Financial Reporting Directive itself. The data has been uploaded online. You will also find at the end of my presentation the website of the Alliance for Corporate Transparency. You will find all the data set, which is really extensive. And we invite you, of course, to check the data online, consult the database, and if you have any questions, of course, by all means, do reach out to us with any comment you may have. An important or an interesting aspect is that you can filter the results by region or by sector, depending on what your interest is, on your background, and you can also consult the response of each individual company. But an important element to note is that we did not create a benchmark of how companies perform in terms of reporting. That was not the objective to measure companies against each other or to create a benchmark, but really the objective was to capture the status of sustainability reporting in Europe. So that's how the methodology was built. Now, before moving into the details of the research, I'd like to maybe perhaps highlight a couple of notes relating to the methodology. In terms of the methodology, what we did was we looked at how companies reported on their overall business model and the governance. And then, as highlighted in this slide, we also looked into the 4 sustainability areas outlined in the Non-Financial Reporting Directive. As you can see, we have environmental matters, social and employee matters, respect for human rights, anti-corruption and anti-bribery matters. And for each, we then looked at how companies report on policies, outcomes, risks, and KPIs, as you can see at the very bottom of the slide. Now, for each topic, as well as looking at, let's say, more general questions on whether companies reported or not on policies, outcomes, risks, KPIs, so on and so forth, we also looked at more specific questions and criteria, which is why we have such a, an extended methodology with hundreds of criteria, all of which reflect, as I mentioned, existing standards and existing frameworks. Now, another important part to highlight is that all of this was done keeping into account the materiality of different topics. So the results do reflect sector-specific considerations of what is relevant or what is not relevant for companies. And the objective for me now will be to try and give you, let's say, a sense of the main findings of the research through some general remarks to start with, but also looking into more specific findings relating to climate and also other broader environmental matters. Until now, I've provided you with a bit of context and background, and now I'd like to move into the actual details of the research, starting with the scope. Now you can see that this image provides you with an understanding of where the companies that were included in the assessment are based and located. And you can notice that there is quite a noticeable bias towards the biggest economies in Europe. Meaning that most companies were located, in the biggest economies of the continent, and which is why we then decided to group the results per region, rather than looking at individual countries to ensure a balance in the sample. So, as a matter of fact, that then means that when you read the report, the section on cross-regional analysis will be based on this type of consideration and distinction, rather than focusing on each individual country. Then you can also see listed on the right-hand side the sectors that we took into account. We have 11 sectors. And again, these reflect the main economic activities in Europe. And everything was done to ensure a balance. Now, this is not included in this slide, but also in terms of size of companies, we try to ensure a balance of companies that fall under the scope of the directive from the perspective of size. Now, looking into the actual results of the assessment, I'd like to move from the scope to the presentation of information. Now, presentation of information isn't specifically required or, let's say, guided in the Non-Financial Reporting Directive, but it is something that our analysts were asked to look into, because somehow it reflects, it's a proxy for how accessible the information in reports is. And as you can see from this slide, we have that a majority of companies, did provide a non-financial statement, which is, of course, a very positive finding. But then we identified weaknesses when we looked into more specific criteria. So, for example, you see that around 10%, specifically 10.5% of companies did not provide any KPIs. So there was no relevant data in the reports. And only around 22% of companies provide KPIs in summarized tables, which, on the other hand, implies that there is a very big majority of companies for which data is scattered throughout the reports, meaning that it's challenging to identify and very difficult for analysts and whoever is interested in reading the report to understand what is actually going on in the companies. Now, if we move to the bottom of the slide, you'll also see that there was a relatively low percentage of companies following a clear structure in terms of reporting on policy, outcomes, and risks. So that means that it wasn't very clear how the information within reports was connected with different parts of the reports. So why do companies report on certain policies? How are the risks related to those policies? And all of this, creating connectivity between all of these aspects, is, of course, essential to evaluate the performance of a company. And you can just imagine how difficult and challenging, and may I say maybe even frustrating for people reading a report to find useful information and to make sense out of that information if a clear structure isn't followed. Now, as I mentioned before, we looked into, for the main sustainability areas, we looked into how companies report on policies, outcomes, risks, and KPIs. And this is really what I'd like to focus on now. Right here in the slide, we provide data on how companies report on policies for example, climate change, polluting discharges, and so on and so forth. And these results, I will focus on the overall implications of these results, but these are really, reflect the essence of the research. So in this slide, you can see the amount of companies that do not report on policies, the companies that do report on policies, but do so relatively vaguely, and those that instead are very specific. So they include, key issues and objectives of their policies. And there's a specific way of reading this slide, which is to compare the overall majority of companies that do report on policies in some way. So for each sustainability issue, you can observe that generally most companies do report on a policy, but then only a small fraction of all these companies is very specific in their description. And this slide specifically focuses on policies, but similar trends were observed also for outcomes or for risks, and perhaps even with even lower percentages. So in a nutshell, I'd like to really highlight this finding to suggest that in overall, whether that was, across different criteria or looking at different sustainability matters, there is generally a big gap between companies that do provide some sort of information and only a small minority being specific about the information that is being disclosed. Now, in addition to these questions on policies, outcomes, and so on and so forth, I mentioned that we also came up with more specific questions and more specific criteria for each topic. And I'd like to provide an example by focusing on climate change. As you can see, for climate change, we looked into how companies report, for example, on targets or on risks. You will find a lot more on the database and in the report, so please feel free to consult these at any time. I'd like to focus on some of these findings. And I think it's particularly interesting to focus on targets and look at the very low percentage of companies that report on a climate target. So we have 36.2% of companies included in the research that report on a climate target. And this is not something that I've included in this slide, but an important element to highlight is that the performance of the energy sector was in no way better. So that was around 36.4%, which is, something that is very striking. And then you can see that values decrease further with questions becoming more specific. So if we move to the right-hand side of the slide, you will notice that only 13.9% of companies aligned their targets with Paris Agreement or the Science-Based Target Initiative. And this is, very important if we're to understand how companies are aligning their strategies with global goals, for example. Now, on the bottom of the slide, I've included some figures relating to risks. And what we did in terms of risks related to climate change was that we integrated the European Commission guidelines on non-financial reporting with regards to climate-related reporting, which of course integrate the TCFD recommendations. And for the purpose of brevity, I've included just a few examples, but again, you will find a lot more details in the report and on the database. Now, as you can see, companies were relatively mature in reporting on climate-related strategies. So 1/3 of companies report on climate-related strategies. However, please note that this refers to the transparency and not as such the quality and the relevance of these strategies. Then again, however, when we looked at climate scenarios, which is something that is also prescribed by the TCFD recommendations, and we looked into whether companies' risk modeling is based on climate scenarios and if companies provide some information on these scenarios, including also a well below 2 degree scenario, well, that's where we identified serious gaps and weaknesses. So we have only 6.6% of companies that report on such an aspect. Perhaps something to highlight here is that companies from the energy and resource extraction sector performed better than the average, as you can see in the bottom right of this slide. So we have 53% of the companies from the energy and resource extraction sector disclose a strategy, while 22% did so for climate scenarios in line with the Paris Agreement. However, that's still not enough. Now, before concluding, I would like to move on to another slide that focuses no longer on climate change as such, but on broader environmental issues. And again, here, the same as for climate, as well as for other issues, whether that's social-related issues or governance, we identified that company reporting practices are not mature. So once again, what we've done in this slide is to present the issue on the left-hand side of the slide. So we have natural resources, pollution, waste, and biodiversity. And again, what you can notice is an incredible gap between the amount of companies that report on the issue, so that mention the issue within their reports and non-financial statements, and those that are actually specific about risks regarding those issues. Now, of course, it may well be that some companies do not face any risks in specific areas. However, the extent of the gap can perhaps be viewed as relevant in this sense. So what are the questions and what are the implications and potential conclusions that we can draw from this slide? Should it be that companies should be reporting more on risks, or should companies not be reporting on specific issues? So perhaps companies are reporting on issues that aren't, as a matter of fact, particularly material, and companies should be reporting less on these issues. And again, I think this gap between companies addressing an issue and those being specific about risks could be viewed as putting into question the relevance of the information that is being disclosed. So in terms of key findings and conclusions, an element to highlight is that I've really touched upon very few elements of the research. It is a very broad research, so you will find a lot more online through the database and reading our report, where we've tried to draw some conclusions. But we'd really like you to draw your own conclusions based on the interest that you may have in a specific region or a specific industry and sector. But there are some points that I would like to highlight based on today's presentation. The first being that we can't really have reliable reporting with only 22 or less than 22% of companies that provide data in tables. This makes it really hard for readers to access the information, and really quite frustrating to understand how a company is performing. Now, the second point is that current reporting requirements are resulting in very vague descriptions of policies, outcomes, and risks. We find, between 20 to 25% of companies being specific on risks, for example. And this is something that should be taken into account in the revision of the directive if we are to have more specific disclosures. Moreover, another element is that companies aren't sufficiently reporting on targets. As I said, we identified 36.2% of companies reporting on climate targets, and this is not taken into account companies that report a target aligned with the Paris Agreement, where numbers were even lower. And this is, again, something that needs to be taken into account in the revision of the directive, as well as the fact that it's clear that companies aren't really following the TCFD recommendations, or at least not yet, as we notice from 1/3 of companies reporting on strategies and less than 1 out of 10 companies reporting on climate scenarios. And lastly, concerning other environmental issues, we observed major gaps between companies that do address a specific issue in their reports and those that report on risks in a specific way, which really puts into question the relevance of certain information, or similarly could highlight that companies aren't being transparent about their own risks. So again, these are just a few, very, very few conclusions that can be drawn from looking into the research that we've conducted. As you can see from the following slide, as I move it, we've included the website link, which you can follow to access the online database and the report. As I mentioned, you can filter results by region, by sector. You can look into the specific responses of the specific assessment of each individual company. And if you do have any questions, by all means, do follow up with us. You can ask questions today or also in the days to come if you can think of other ones following this webinar. So thank you very much. And I'll pass over to Michael.
Thank you very much, Joanne. And hello, everyone, and thank you for joining us today. My name is Michael Zimonyi. I am the Policy and External Affairs Director at the Disclosure Standards Board, CDSB. I think Joanna's presentation has really highlighted the importance of the revisions that are going to be taking place this year. It's clear that the directive, the Non-Financial Reporting Directive, has made progress in the quality and the quantity of information that is available on corporate performance. but that we still have a long ways to go. And this is really CDSB's interest as well. And just to recap on Mardi's presentation, our mission at CDSB is to support businesses through the CDSB framework and other technical support material and education to help them integrate climate change and natural capital information into their management reports or annual reports to make sure that this information is available to investors and other stakeholders to inform their decision making, to really help them with making informed and more comprehensive decisions based on a more complete picture of a business's performance. So with that in mind, and building very much on the findings of the Alliance for Corporate Transparency, which I encourage you to have a look at the website, as the database is very interesting, and I spent quite a lot of time on there. What CDSB has done is that we have come up with a set of red lines which highlight the changes, the updates that we believe are needed to ensure that the Non-Financial Reporting Directive lives up to its ambitions and it achieves its objectives. So as we look at the Non-Financial Reporting Directive, the most important aspect to keep in mind is why do we have this directive in the first place? And as I said, is to inform decision making of investors and others. With that in mind, it is important that those readers of the information are able to actually find the information that you have reported. So our first red line is to ensure that this information is reported in the management report of a company, and the current exemption to report this information separately and up to 6 months later is removed. It is important, of course, because the Alliance for Corporate Transparency's research and also upcoming research by us has shown that it is difficult to find this information in some cases. And actually, the European Commission, in its impact assessment consultation, has also highlighted that it is hard for investors and other users to find non-financial information, even if it is reported. Making sure that the information is in the management report means that it is in a single place, regardless of the company, and the user of the information knows where to go to find this information. It also helps with the connectivity of the information. It ensures that when a user of this information looks at the non-financial performance of a company, it can also draw linkages and find the connections between financial performance. And this is very important for an investor audience, making sure that they can make the links between non-financial and financial aspects of a company. It also helps with the trust of the information, because if it is reported in the annual report and the management report, it means that it has been signed off by the board. The annual report is a trusted document, and so as a reader, if I'm looking at the annual report of a company, I know that this information has gone through the necessary processes to ensure that it is suitable for my decision making, whether it be engagement with the company or investment decision making. And last but not least, it is important also to note that if information is reported outside the annual report, then it is not suitable. It is not suitable for supervision, because supervisors do not have the mandate to look at this information and supervise it. And if we have a non-financial reporting directive, but the information is not supervised, then the directive actually loses a lot of its force to make sure that we have the same level playing field across the market, and that investors and others have information for a complete set of data set for their entire portfolio across European businesses. And one point actually to add is that if information is reported up to 6 months after the annual report is published, or the financial information is published, it is 6 months too late to be included in financial analysis. So making sure that the information that you report is actually used, it's important that it is included in the management report. Second, our second red line is to increase the scope of the companies that are captured under this non-financial reporting directive from the current 500 employees and up to 250 employees and up, to ensure that, again, we have a more complete data set and a more level playing field, but also because the number of employees is not always the best reflection of whether environment and other non-financial matters are material to the company. It is often, of course, determined by the activities of a business, and so you can imagine a smaller company. Let's take the usual oil and gas sector example. If the oil and gas sector has quite complex corporate structures, and it might be that a much smaller company has a much more material environmental aspects that are important for an investor to understand than a larger business that might have less sort of physical activities within its business. So it is important that we have the right businesses reporting this information, and all the businesses that should be reporting this information to make sure that the directive is fit for its purpose. Now, it's important to also note, of course, that the materiality threshold of the directive is very important to ensure that we reduce the reporting burden. So, of course, information is only to be reported if it is material. And so if it is not material, it also ensures that companies are not unduly burdened by excessive reporting requirements. The third recommendation, or the third red line, is to apply the TCFD recommendations within the Non-Financial Reporting Directive, and the incorporation of the TCFD's recommendation is very likely to be part of this review by the Commission. The Commission has already, of course, launched an appendix to the non-binding guidelines to the directive, which also have been a reaction to the TCFD recommendation. So it is clear that that's going ahead. But we also believe that these recommendations are also useful to improve not just climate change information, but other information such as biodiversity and natural capital related information. The perspective of the TCFD on financial stability really lends itself to make sure that investors understand such information, even though they might not be versed in ESG matters, and they might not be ESG analysts, for example. It ensures that we have a unified approach across various thematic elements of non-financial and financial information. And it also, of course, ensures that this approach is consistent, not just within Europe, but also globally. And in a global market today, it is really important that we have consistent and comparable information. The TCFD's approach also strengthens the links between financial and non-financial information, and this link is something that we have also found to be still in its infancy, and there is a lot to be done to make sure that we strengthen this and clearly communicate how certain non-financial matters might have a financial consequence as well, whether it be positive or negative. To achieve this, it's important that we include all 4 elements of the TCFD, so the governance, strategy, risk management, metrics, and targets. These are elements of this already in the Non-Financial Reporting Directive. It's just making sure that we evolve these requirements to make sure that they are consistent and in line with the TCFD recommendations. An interesting finding that we found looking at any reports is that some companies might not be clear on the fact that when the directive requires environmental matters to be reported, it is not instantly obvious to them that this, of course, includes climate-related matters as well. And as with any regulation or directive, it is important that we get those definitions right and we are clear in our expectations to companies. So explicitly stating that climate change-related matters are an element of natural capital environmental disclosures that are required is another amendment that we highly strongly suggest. Last few points. It is important that we keep the investor in mind when updating the Non-Financial Reporting Directive. That is, of course, not to say that other stakeholders are not important. It is purely to ensure that the investor, as a very specific stakeholder type, receives information that it needs to make decisions, and also in the format and in the language that it understands and can act on. An important element to ensuring this is around the determination of what is material to be included in this management report. And what we have found also looking at reports is that while there is growing incorporation of wider stakeholder related matters that are material to wider stakeholders, the investor audience is deprioritized in some cases. So it's important to realign and make sure that the investor is not left out of the loop as part of this update. Our last red line is to strengthen governance disclosures. As Joanne has mentioned, only 37.5% of the 1,000 companies that they have reviewed had a clear structure for policy, outcomes, and risks. And this means that we need to be clear in the directive, making sure that the expectations are set unequivocally. And an additional way of ensuring this is actually to go beyond the Non-Financial Reporting Directive and go into Article 20 of the Accounting Directive, which is, as Mardi mentioned, is the directive which forms the context for the NFRD, and include the TCFD's governance requirements into the corporate governance statement requirements in Europe. So again, just aligning various reporting initiatives and practices to make sure that we have a consistent landscape. An interesting finding that we found looking at annual reports is that there has really been a significant variation of what companies have reported under policies and due diligence. And again, this might be due to the lack of definitions to these two terms. And so we strongly recommend that these two terms are defined, again, making it clear what is expected of companies. And last but not least, don't forget supervision. As I mentioned, regulation is only as strong as its supervision. And the European Securities and Markets Authority has done great work coordinating European supervisors in sharing and exchanging practices and building capacity as well. And so I encourage you to look at their report on enforcement. It's an annual report if this is of interest. And it's important to make sure that we supervise so-called non-financial information with the same rigor as financial information as well. Make sure that we have a good feedback loop to companies of what is expected of them, and also build trust and increase the quality of the information that is reported to investors. So I will leave it at there, and I will hand it back to Julia. Thank you.
Thank you very much. And we can move forward to the Q&A session. There have been quite a few questions already. You can find them in your Q&A chat. Should we start with you, Joanne?
Yes, sure. Can you hear me properly?
Yes.
Perfect. Thank you very much. Yes, so I see a few questions, and I'll try to answer. So one question is there a database with all companies with the reports that report based on the EU's non-financial reporting directive? So this was one of the issues that we encountered at the very beginning. So there is no public, let's say, database from what we know that collects all the existing, let's say, the list of companies that fall under the scope of the directive. And in fact, generally speaking, the understanding is that this number fluctuates between 6,000 to 8,000 companies. So that was really something that, took our effort to identify companies that would then fall or that would then be suited to be included in the research. But from our perspective, the 1,000 companies that are included in the research of the Alliance, those companies are indeed, you can see the list of the companies online. So I hope that helps. I also have another question relating to key issues and objectives. So when talking about key issues and objectives, does this refer to metrics and targets? So yeah, this was discussed in relation to policies. So in fact, there was mention of whether or not companies report on policies in a specific manner by focusing on key issues and objectives. And the idea, was really to, this box was ticked, let's say, if companies identified, let's say, specifically what the policy was addressing. So let's say the social or the environmental impact, the specific impact caused by the company, and what the targets a company had in place to address that element. In terms of further questions, there's another one focusing on the total sample size, so other information relating to the scope of the research and whether or not the results are disaggregated based on regional considerations. So yes, so here I can provide a specific number of the report, which is page 11 of the report, which is available online. And this provides a breakdown of the sectors per region. So you will find all the sectors that were included in the report, as well as the regions, and you will find in each region how many companies from that sector were included in the research. And in terms of results disaggregated by regions, we have some relevant values are included for the purpose of an analysis in the report. But then for a broader overview, you can also check the database, and there you will be able to filter the results for each criteria by region. And practically speaking, you will find a little tab on the top right of the website with a drop-down menu where you'll be able to select the different regions that you're interested in. And then a final question relates to the gap between reported information and specific risks. What are thoughts behind the reasons? And so for this, an important element to highlight is that the research didn't look into, reasons of why companies report an aspect rather than not. We really looked at whether, companies reported on a matter and the quality of disclosure. So in that sense, the research itself does not answer this question. But, almost certainly you can answer that this question really, highlights the vague requirements added to many rating agencies asking for different types of information. And confusion on what to report from companies can probably be seen as contributing to this gap. But again, I'd like to highlight that this was really not the purpose of the research. It was really to look into the quality of disclosure rather than the reasons. Again, there's many conclusions that can be drawn, but this is not central to the research. So I see some questions relating to the study, of course, given that was the focus of my presentation. And I see that one question is, for example, why was carbon-intensive industry, e.g. cement, steel, chemical, paper, not included? As a matter of fact, it was, but for a matter of categorization, we included these subsectors, let's say, within the resource transformation sector. So if you look into the database online where we've analyzed where we present, the results of each individual company, so how each company has reported, you will see, as well as a macro sector, also the subsectors that it covers. So if you look into resource transformation, that's where you will find cement, steel, chemical, etc. So that's on one point. Another question is, in the climate change slide, is the data from companies all over the EU, and is it just energy sector companies? So yes, so the companies that we included were those falling under the scope of the Non-Financial Reporting Directive, so companies here in Europe. And in terms of let's say the sectors, no. So those values and those numbers refer to all the companies that were included in the research for which the matter was, material. I mentioned the energy sector performance. So if we think the 36.2% of companies report on a climate target, and then I mentioned that 36.4% in the energy sector report on a climate target. So that was just my addition to the slide. If you go onto the database, you'll see that you have the possibility to filter. First of all, select the criteria that you're interested in. So that's climate change and focusing specifically on target. And then you can also select the specific industry. So then you can see how each individual sector performs in that sense. I have another question relating to, is it possible to provide absolute tons of CO2 emissions covered in the study by participating companies or by the included companies? So one point to highlight is that the research focused on the quality of information. So we didn't engage in providing or calculating the results ourselves, but as I said, you can access the database and access each individual response. So through that, you can then refer to the climate change sections of the report. So hopefully that would be able to help. And then I have a question about the connection of the alignment of the Non-Financial Reporting Directive with the EU taxonomy. So this is something, well, first of all, as part of our research, we also looked into how many companies report on products or services, that support climate change prevention and adaptation. And we noticed that less than 40% were doing so. And this, relates to the sustainable taxonomy. There, in terms of alignment, this is something that is being discussed, and the taxonomy regulation will require companies under the scope of the directive, of the Non-Financial Reporting Directive, to disclose certain indicators on the proportion of their activities that are classified as sustainable according to the taxonomy. But the alignment of the Non-Financial Reporting Directive with existing legislation is definitely something that will be kept into account in the review and the update of the directive. So I think these are all the questions assigned to me. I have another question regarding to why packaging companies aren't in the scope. Again, that would be a subsector included in the resource transformation sector. So although we've grouped all the subsectors in 11 macro sectors, you will find that all of the sectors that you're thinking of most likely fall under the directive. Fall under the research. I think I'm wondering if there's any other. Is it possible? I see another question relating to whether or not people can access the database and the research. Of course, if you just click on the last slide included in my presentation, and I believe the presentation will be shared following the webinar, you can access the website, and then from there you'll find easy access to the report as well as the database.
Thank you very much. Mike, there were a couple of questions for you and Mardi as well.
Mm-hmm.
Yeah.
So the first question is about what should ideally imply strengthen links between financial and non-financial. That's a very good question. It's certainly an evolving area of disclosures, but what we have actually done in our red lines, in a longer version of the red lines, which you can see on our website at cdsb.net/NFR, is to actually track changes to the existing directive to show what we mean. And two examples I'd like to use is around principal risks. So talking about whether the directive requires the disclosure of principal risks, including a requirement to disclose also how these relate to the position and the performance of the undertaking's business strategy. So really talking about how this relates to your business strategy, and for example, around non-financial key performance indicators, identifying the relationship of these KPIs to the financial position and performance of the business. So linking really to financial performance the various matters, and there are many different approaches, but there's not one way to do it just yet. But it can also be a narrative, or it can be more specific. We've seen different approaches. We are getting more and more questions, which is great. So I perhaps jump on a few of those. So a question for me. When you say that reporting in a management report should be made mandatory, do you mean that companies should include all their environmental information in the management report, or they can still include an environmental statement to the management report? So what we mean here is reporting material information in the management report, so not reporting it separately in a separate sustainability report or on the website, and of course not up to 6 months later. Now, this doesn't mean that we are advocating for deleting the concept of separate reports. These are, of course, very useful documents for various purposes, be that, for example, for informing other stakeholders. So perhaps you might report and might communicate differently to the communities in which you operate, or some of your customers that you might want to inform, as compared to your investors, for example. And it's also important that we don't clutter the annual report with too much information, because then it's really difficult to see what you as a business have determined to be material and what is just additional information. So one good practice that we have seen is that companies report the most material information in their management report, in their annual reports, and then they provide a link to further information, be that a separate sustainability report or their CDP response or some other information. So that's perhaps hopefully a bit of a clarification. Should we go further than risks and rethink accounting methodology to include non-financial capitals? That's a very interesting question. And we have done quite a bit of work on looking at financial accounting standards and financial reporting standards and how they might relate to non-financial, so-called non-financial matters, because they do have a financial impact. So if you are interested in that, please drop us a line. I'd be happy to connect you with some of my more technical colleagues. It's a very interesting and very quickly growing area as well. Another question we have, don't you think that the business size of 250 employees is not too small? Because at the end of the day, the big companies will ask suppliers to give information on risks, targets, and so close the loop. An excellent question. And this is where the Non-Financial Reporting Directive and the Accounting Directive is actually quite elegant in that it doesn't require subsidiaries of companies to report this information separately if the parent organization is reporting already. So this doesn't mean that some companies would be captured twice. It just means that those companies that have not been required to report before will need to be required. So the companies that are not captured yet, that are over 250 employees, would be required to report now. I have a few more questions coming up, and I'll quickly answer those. How do you establish the materiality of a matter regarding the decision to report or not a specific information? Well, that's a difficult question, and really this is where the materiality definition comes into play, and also looking at your board and your wider governance to give you a direction of towards where what is considered material. But generally, so the financial materiality definition is around roughly put, if you not including this information would influence the decision of the investor, you should put it in. So is it significant enough, is it material enough to the investors? Will it influence your decision making as well? There appears to be a focus so far on investors and linking to financial information, but how does this reflect fully the EU's concept of the bill of materiality? A very good question, and the best way to approach this investor materiality is to recognize that even the double materiality perspective has one side, which is to report the impacts of the environment on the business. So how will the environmental matters impact me as a business and my performance? That's the financial materiality side. And then there's the wider stakeholder materiality, is what is my impact on the environment or other ESG matters as a business. Now, the second would not seem to be relevant to investors, but these impacts of my business will have ramifications either through an impact on my brand recognition or brand image, through fines and other matters. And so most of these elements will have financial implications as well. So sometimes these are just two sides of the same coin, and explaining these matters in a way that makes the investor understand why they need to look at this, and then of course explaining what you're doing to manage these risks is perhaps a good way to look at it.
We have a question about the difference between the Non-Financial Reporting Directive and ESG reporting. Well, it's essentially one of the same. It's Europe's implementation of ESG reporting in legislation. However, when we talk about ESG reporting, we often talk about an investor-oriented reporting, and this perhaps goes a bit further. There are elements that that also take into account the wider stakeholder perspective. This has pros and cons. Of course, it's important that we are transparent to all of our stakeholders, but it also means that sometimes we end up with too much information in the annual report, and so it's sort of hard to see the wood from the trees, and then there might be a bit too much information. So one of the things that the Commission is looking at, and one of the elements that we are focused on very much in this process, is to make sure that we have concise information that is clearly targeted at the investors, to make sure that the reader of the information sees what is most material from the company's perspective. When is a company public interest entity? Are there other requirements? Yes, so public interest entities are over 250 employees. So this 500 employee threshold was just assigned just for this non-financial reporting directive. And there are some requirements on revenue or turnover. And I will not try to remember the number, but so it's both a financial and an employee threshold that companies need to pass to be a public interest entity. Some are listed, but there are some other large organizations, such as some banks, that are in the public interest. So they are also determined by the national legislator to make sure that it's sort of the legislature there has also a say in this. So if you're a public listed entity, you would probably know, or your company secretary would be able to help with this question. There was a question, I can't see it now, but it was about inspiration can we have a source of inspiration to report according to the non-financial reporting directive requirements? I'm not sure what would be most helpful, but one excellent source, if I may say so myself, is a recent handbook that we have published, a non-financial reporting handbook, and it's available on our website, where we have looked at each requirement of the directive and have actually found real-life examples of actual company reports to show how some others, perhaps in your sector or your fellow companies, have implemented the requirements, what they have done well, where they could have done some things differently. I think it's a very useful resource. There's also a similar resource published by EFRAG, the European Financial Reporting Advisory Group, of which we're a member and also contributed. So there are a number of examples of reports that hopefully can inspire you to in your reporting.
Thank you, Michael. There's just one question for me, and it's about thinking about the regulatory perspective and whether the current approach, which is a one-size-fits-all approach, and would sectoral KPIs, instead of expecting all companies to report about everything, be a better approach. I guess the regulation sort of sets out the high level expectation for what they are expecting for companies. The regulation will never tell you what's material for your business, what is the most important part of your story to be telling. For those of you that are thinking about reporting in line with the Non-Financial Reporting Directive, or don't know where to start in terms of your sector guidance, I would suggest looking at CDSB work, and they have detailed KPIs, metrics, target framework for each individual sector. So that's a good place to start, and then evaluate that against your business and go from there. Likewise, you may already report sectoral information through your industry groups or via GRI or CDP. So I'd also look there and see what you have and evaluate it from there. There's one here. Are there any comparable regulations in the US, Canada, or China? As far back as 2010, the US took a real lead here and published interpretive guidance for reporting climate in the 10K. So although it's not enforced, that regulation still, or that requirement, the interpretive guidance to help companies do that, it does still exist to this day. We're seeing really interesting interpretations of what we're seeing out of the Non-Financial Reporting Directive manifest in Japan, Australia, countries in South America, China's got new rules for the stock exchange. There's Hong Kong. We're seeing really different ways that the inspiration has been taken for what has been done in Europe and is rolling out across the world. So there is another question about supply chains across EU markets from outside the EU. And I think that will really start to be key as the directive is revised and expanded, not just from, but I shouldn't say just because of this directive, but across the more sustainable finance portfolio in across Europe more broadly. The rationale for that is that because of the increased amount of information required under the directive, companies need to be more aware of what's in their supply chain, both looking at what was previously the dependency on those resources, but also looking at the impact of where they're buying and procuring and using labor, et cetera, through their supply chains. So I think there'll be more and more accountability that is actually required from companies outside the EU supplying in, and equally that apply with investors wanting to know more and more about those companies as well. So there's I think if you're outside the EU and you're watching what's going on now, if the revisions that Michael has proposed go through, then that will almost roll out to around 80 or 20,000 companies across Europe, which could in fact create a global tipping point for reporting. So I would, if you're outside the EU, watch what's going on in terms of this directive, because in some fashion through your supply chain or reporting, in due course you may find that you're required to comply with some of it. There is a question on assurance, which often comes up, assurance and verification, but assurance by external auditors and whether or not that should be required. So CDSB, the line we have is we don't mandate assurance, but we suggest that you prepare and collect your information with the same rigor, using the same sort of internal controls as you would financial information, so that it could be assured if it had to be assured. It's how much confidence you have in your data, whether or not you put more time and effort up front in preparing, investing in getting external support to put those external controls in place so that you can, later on, it doesn't require as many external costs, or you can just be confident internally with your data yourself. There's a question regarding GRI and what is the role of GRI in and what's different from GRI from what's being proposed for the Non-Financial Reporting Directive. So the Non-Financial Reporting Directive, the primary audience is for the data is investors. With GRI, the investors are one of the many audiences that the data is tailored for. So there may be different boundaries for the data, different definition of materiality, and in an annual report, the purpose of this is to tell the value creation story, but link it to the numbers, link it right through the governance, risk, strategy, metrics of the business. And requirements to report with GRI are slightly broader than that, so they would tend to sit, although they can inform what you do under complying with the Non-Financial Reporting Directive. They're often much broader, so it's you will get more value from reporting outside the annual report for GRI, but you can use data you collect for it to report against the Non-Financial Reporting Directive. Likewise, with any of the standards already out there, so CDP as well, there is a hugely rich data source from companies reporting against SASB, CDP, and GRI already that can be used for non-financial reporting. So I do urge people to look at what they've got before they get started. I'm just going to hand back to Mike. I think there's another question for him that's just come through.
Yes, and I will be very quick. I know we are approaching at the end of this session, and but there are some excellent questions coming in, so I just wanted to pick up on a few of them. And moving on from Mardi's point about various reporting standards, the question was about whether we're proposing to sort of merge the sustainability report and the annual report. That's not necessarily the case. I think it also goes back to what Mardi mentioned about the different audiences, and perhaps the sustainability report is a much better way to report to a wider stakeholder base. But it's also a very useful tool to provide more detail and reference the sustainability report in your annual report. So really highlighting what is most material in the annual report, but preferring the reader to the sustainability report for more information, and really to show your working, so to speak. So to show them that you have considered this in greater detail. So there is still a role for the sustainability report in this. A question about prioritization. Perhaps are there any red lines that are more important than others? The order that we've presented them in is a rough prioritization of these. We do believe that by making reporting mandatory in the management report only, we will solve a lot of the issues with quality and consistency and comparability and governance of the information. So that's very key. And then increasing the scope, of course, will have a significant impact. So those are the two key points that I would highlight. And the last question I wanted to answer is, of course, about Brexit. What does this mean for UK companies following EU directives further to Brexit? So the current requirements are in force in the UK as well. And the UK is actually moving quite quickly ahead on climate change-related financial disclosure. So they have the UK has set out expectations for mandatory reporting on TCFD to be assessed by 2022. So if companies are not reporting sufficiently in line with the TCFD by 2022, then there will be a move to make it mandatory. And in fact, there are actually legislations going through Parliament in Westminster on pension fund TCFD reporting, and even listing requirements for premium listed companies in the UK. So I would say that the UK is moving in the same direction and very much aligned in this way. I'll stop here, but I don't know if Joanne, you had any other questions you wanted to answer, or maybe we can hand back to Julia to wrap up.
Yeah, no, I think that's I think everything is very clear, and I don't have anything else to add for the moment. Maybe one quick note that you just mentioned as well, that having specific requirements in place. This is also something that I didn't mention throughout the presentation, but if you think of national legislation that implements a directive in a slightly different way and requires very specific requirements, then we noticed improved transparency in that sense. So if you think of in the UK, we have better reporting on greenhouse gas emission intensity due to national legislation specifically focused on that. In Spain, on gender pay gap. So this is maybe something also to keep in mind, that very specific requirements on elements that are standardizable is something that can really help. I think that's everything from my side.
Thank you very much. I'd like to thank our audience for their questions, and I'd like to thank our speakers for their presentations. If there are any questions we have missed, please send them by email to info@cdsb.net, and we will get back to you. Just to confirm, we will send the recording and slides within a couple of days. Before we wrap up, we'd like to highlight some of our upcoming online events that will take place in May and invite you to take part in them. On 13th of May, CDSB's Managing Director Mardi McBrien and CEO of CDP Paul Simpson will host an exclusive webinar to mark the release of a new guidance on using CDP data and the CDSB framework to successfully fulfill the recommendations of the Task Force on Climate-Related Financial Disclosures. We also invite you to join us on 19th of May to mark the launch of CDSB's extensive analysis of climate and environmental disclosure of the top 50 European companies by market capitalization. You can learn more about these events on our website, cdsb.net. Last but not least, we thank the EU Live program for their contribution and support. Thank you and have a good day.